Tom, thank you very much. As you say, I'm here with Larry Fink. He's the CEO and chairman of BlackRock, the world's largest asset manager. Larry, Tom was just saying, BlackRock reported what nobody could describe as anything but strong earnings this morning. There's a lot there to please your investors. Earnings per share of $6.66, 125 basis points, possibly more, I think, of margin expansion. Assets under management of $6.3 trillion. And perhaps most impressive for a company of this scale, continued double-digit revenue growth.
Right.
But analysts were expecting a strong quarter, so it's fair to say the questions immediately are going to turn to flows.
Right.
Not just ETF flows, net inflows.
Yes.
Long-term inflows of $14 billion, the smallest for BlackRock since the second quarter of 2016. What's going on?
You did your homework. Thanks, Eric. Well, I think we said in our press release, it was a very good quarter. You went over the financial metrics. We saw clients worldwide pause. We saw clients they're confused. They're confused as to what direction the markets will go.
This is what they're telling you.
Absolutely, and I'm traveling everywhere, as you know. Clients are questioning the whole foundations of international investing, and that's the foundation of globalization. As we start entering this conversation about trade and tariffs, we're seeing clients pull back a little bit. They're waiting to see how does this play out. The backdrop is we have very strong earnings. Mm-hmm. First quarter we saw very strong earnings throughout the S&P. We believe we're going to see strong earnings in the second quarter. We're going at a rate of $800 billion of stock repurchases. We have record amount of M&A. So the backdrop is we're shrinking amount of equities. We have record earnings, as I said, and yet markets are essentially unchanged.
Does that surprise you?
Oh, absolutely. If you asked me at the beginning of the year, we're going to have record amount of M&A, record amount of earnings, and record amount of stock repurchases, I would have said the market would be up 10 to 12%. And markets are essentially flat. Now, if you strip out
So instead of the S&P 500 at 2,800, it would be more like 3,100.
Yes. More importantly, though, if you strip out the 7 major tech stocks that have done very well, actually the breadth is really poor. And we're seeing evidence of that. But let's go deep into the flows, because the flows really don't, the overall macro number doesn't tell you what was going on. We saw a lot of churn in our index equity business. And that's where we saw the outflows. We had about $13 billion of outflows in that area, very low fee things. And we saw investors pull out of what I would say emerging markets and other areas. And I need to remind you, cash for the first time since 2008, a little before that, is earning you a return. You're earning 2+.
Why is that important?
You could pause and earn money in the last 9 years.
People can afford to wait.
You can afford to wait. And this is a huge change in the marketplace in the last 9 years. And people have forgotten about that. You're earning almost 2.5% now in a money market fund. That's pretty similar to the 5-year Treasury. You could pause. And by the way, equities are not up 2.5%. So you could be earning money in cash and pausing. Let me get back to the flow.
Hang on a second. Should people be pausing? Does that seem like
no, I actually,
a wise, smart thing to do right now?
It depends. If your horizon's the next 5 years, it's probably good to pause. If you're focusing on your retirement and your pension fund, you should never pause. You should be continuing to invest. So it really depends on the time horizon. We saw $4 billion between flows and commitments in alternatives in our liquid alts. We had $8 billion in flows in our multi-asset. So if you break out all the flows, right. Positive flows in
money's
fixed
going
income,
some places, money's coming out of other places.
But we've seen huge churn, and if you strip out the index business, which is virtually low fees, our flows were better than what the headline is, because we had about, as I said, $13 billion of institutional outflows. In iShares is a very good example of where you saw a real decline.
The ETF business.
Yes, in the ETF business. We saw a dramatic slowdown in May and June. We're starting to see an uptick now in July. We're starting to see more flows into it. But our view is the ETF growth, and we anticipate $10 to $12 billion by 2023. So we still expect $10 trillion.
In total ETF market.
We expect ETFs to continue to grow for 4 reasons.
Okay.
Reason one, ETFs represent a great value. ETFs are becoming more and more of a great trading instrument. There was great articles about fixed income. I've been telling you about fixed income ETFs at least for 5 years, and now they're starting to catch on. ETFs are now being utilized for alpha tools. So many investors using ETFs to get exposures. And then most importantly, the biggest trend, and that trend is continuing, we're seeing ETFs being utilized by more wealth management as we see the transition from brokerage to fees. So we believe the future growth of ETFs will continue.
Larry, can we go back to the investor sentiment for a moment?
Yep.
What is it? You say investors are confused. What is it that confuses them?
Well,
and how would you describe the sentiment?
Well, the market performance is validating that confusion. As I said, the fundamentals are incredibly strong. We're going to have a 4+% GDP economy in the second quarter. As I said, record earnings, record stock repurchases, record M&A. That's like nirvana for investing, and yet markets are unchanged. And so the market's having a hard time digesting the whole change in globalization and trade. And I believe this will continue to be a big issue until there's better certainty. And you know markets hate uncertainty.
Okay, well, we've heard uncertainty a lot.
Yeah.
10 years. How does the uncertainty today compare with the uncertainty that investors have known since the financial crisis?
Well, there wasn't. After the central banks of the world stabilized the banking system, I would say there was less uncertainty. We obviously had Eurozone issues. We have all these various issues.
Regulatory issues here in the United States.
But in my 42 years of investing, the one thing I felt certain about, and that is globalization is good. And international trade is very good. And we are now raising those questions. And I think the foundations of international investing are being raised and being questioned. And I think until we have better understanding about this, you're going to see clients pause, keep their money in cash, keep their money in low duration bonds, keep their money in unconstrained bond funds. Maybe if they see a great alternative product, they're going to continue to do that. But overall, clients have a wait and see attitude.
What about your attitude? How would you describe your state of certainty?
I think these are important questions to be answered. And
but do you feel more uncertain than you felt at any other time in the past 42 years?
No. I mean, but I feel in the last 5 years, do I believe this is a more uncertain period of time? Yes, I do. And look at the question I'm raising is this 1994 when the markets were very concerned about growth. Actually, the Federal Reserve, you remember, eased when they should have been probably tightening, and so they got it wrong too. And then the market reasserted itself, and we had a 5-year bull market. We may be in that position. The market may be wrong right now in that GDP will continue to grow. The trade conversation is not that difficult for international commerce, and M&A and share repurchase will continue. If that's the case, we'll wake up in a year from now and the markets are going to be up 10 to 12%.
What's the flip side?
Well, if we have a true tariff wars, we'll see the markets down 10 to 15%. So I do believe...
You wouldn't call this a tariff war?
We haven't... No. We'll see what happens in the next $200 billion proposal that the U.S. government has done with China.
Between now and the end of August.
Yeah, so right now it's talk. Let's see if there is a resolution on that.
Why aren't tariffs on $50 billion of Chinese goods and tariffs on steel and aluminum imports and tariffs that are being imposed on the Europeans with retaliatory tariffs on U.S. goods, why doesn't that constitute a trade war?
Well, it is a minor trade war, but it has very little impact on global GDP. It's just too small yet. But symbolically, it is having an impact. It's having an impact on investor sentiment. And that's what we are seeing right now. We are seeing investors pausing until there's greater certainty.
We talked about stocks. What about bonds? You mentioned that you can earn, north of 2%.
Bonds are fine.
In a money market
account. Keep in mind, bonds are not this one-dimensional product. Do I want to be in long-duration bonds now? Probably not, but I could be in low-duration bonds. I could be in cash. I could be in other types of products. I could be in credit, low-duration credit funds. So you're being paid now to take some risk in the short end of the curve. And the question is, are you being paid enough in the long end of the curve? And I would say probably the long run, no, you're not. I am
at 2.8% on the 10-year. You're not being paid enough.
Compared to that, I could earn 2.5% in a money market fund. No.
What about the inversion of the yield curve?
I've been talking about this for 2 years. I think we will see an inversion of the yield curve.
When?
Sometime this year. But I don't believe it means we're going into a recession.
Why not?
Because we have a Federal Reserve that has already stated they're on a path for 2 to 3 more tightenings. We have an ECB that has stated that they're not going to do anything until November, December 2019. We have a Bank of Japan that has stated the same types of paths. So we're going to have a huge diversion between U.S. interest rates and European and Japanese. And that's why the dollar is strong. And so we're going to see more flows into dollar-based assets, mostly in cash and low duration, and that's exactly what we're seeing.
Okay. So, but again, I'm having difficulty taking all of these discrete pieces of information and adding them up into a picture that tells me something. Where do you think we are 2 quarters from now? Where are we at the end of the year?
Well, we believe at BlackRock that 2018 will be a strong year GDP. That is mostly because of the tax reform. We believe in 2019 the U.S. economy will begin to slow down. Now, if we do implement this $200 billion tariff war between China, I think all bets are off.
Meaning what?
The GDP will slow down dramatically. We will have even more uncertainty about the world and how the U.S. is being portrayed. One thing I will say...
So hang on a second.
Yeah.
The U.S. imposes tariffs on an additional $200 billion
which they
of Chinese
proposed.
Goods, right? Could happen by the end of August.
Yes.
That's going to cause GDP to slow down dramatically, you say?
In 19, yes.
And that's going to do what to financial markets?
I would say financial markets would go down in that scenario.
So, given all of this...
Yes.
How good a job? The economy is growing, you say, at possibly 4% or faster this quarter.
Yes.
How good a job is the president doing managing this economy?
In the short run, the economy is doing fine. Look, I'm a globalist, Eric. I believe in the foundations of how the U.S. has built its relationships.
Why put all these things at risk then?
The president has a different agenda than I believe is the right agenda at this time related to trade. I do believe we should reevaluate our trading treaties with some of our partners over some of these treaties are very old. It's time to reevaluate them. I would do it in a much more private way. I would work it out. I would treat my my global partners and allies with the idea that we can work it out together.
Okay, that's not the approach that the president has taken.
No.
Once upon a time,
and the markets are showing that. That's why the markets are virtually unchanged.
So, once upon a time, you sat on a council.
I did.
That Steve Schwarzman chaired, that advised the president. That council has since been dissolved. Do you have channels through which you can communicate these concerns to the president or to members of his administration?
We certainly have open channels to talk to anyone we wish to worldwide.
And what are you doing about it? How are you communicating these things? Isn't it important, if you believe, as you say you do, that these things matter, that they have consequences for the economy, that they have consequences for investors, they have consequences for the wealth of Americans, and furthermore for the wealth of your clients and constituents around the world, surely you'd want to do something about it.
Eric, markets will speak louder than what any one single voice. I mean, we have channels. We do go through our channels. This week I'm talking to members of Congress on many things. So we have an open dialogue, and We are, last week we spent time with other countries and had open dialogue with other leaders of other countries. So I could rest assured we are having conversations, but unlike some people, I'm not going to talk about them.
Larry, it's a complicated picture in flows for BlackRock in the second quarter, but one thing stands out. Retail investors continue to put money in the market.
Correct.
Institutional investors are taking money out of the market.
Yes.
Some people would say the smart money knows, and the smart money is the institutional money. The institutional money is pulling back, if not just taking a pause, and the dumb money, the retail money, doesn't see what's coming. What do you say?
Well, I would not say that. First of all, some of the outflows that we witnessed were money being used for M&A. Some of the money was used for stock repurchases. So I think that's too large of a generalization. We had money put to work, as I said, $8 billion in multi-asset. We had money being put to work institutionally in fixed income. We had money being put to work in alternatives. So we had $4 billion of commitments and flows. In retail, I would not say retail has dumb money by any means today. In fact, now as retail has migrated more towards a fee-based relationship, that is an institutional relationship. They have CIOs now where they're creating models, and those models are navigating around the money. And I do believe what you're seeing in the retail flows is the right thing. Most people save for retirement. And so that's why we're continuing to see positive flows in retail. And as I said, if your time horizon is 5 years, maybe you should reduce some risk. But if your time horizon is a retirement plan, you have to consistently put money to work up or down.
That's what you should do, but that historically is not how retail investors behave. Retail investors turn on a dime.
No, it's changing. As more money moves to advice,
fee-based
advice, you're not going to see that type of volatility. And that's a positive.
So if the uncertainty due to global trade, due to the breakdown, if you will, of the international order, due to the confrontation between the United States and China continues, what's the picture look like for flows? What do investors do?
They may go more into bonds. They will continue to invest in alternatives. And I do believe some investors are going to look at this as an opportunity to get back into equity. So I'm not worried about flows. And
no, but your investors are worried about flows.
My flows are fine. We've had flows like this. You said in 2016 we had this 2 other times in the last 5 years. We always have pauses when markets are trying to digest information. But I do believe we have never been in a better position. We have deeper dialogue with more clients. We're working on bigger assignments than we've ever right now with some large clients. And so I will still assert that our flows will be fine over the course of the next 12 months.
So if you're right, if that continues, BlackRock is a $6.3 trillion money manager today.
Right.
Where are you 2 years from now?
I would expect us to be larger.
Yeah, I think that would be a certainty if the flows continue.
Yeah.
The thing that investors focus on at BlackRock in particular is organic growth. This has been largely an organic growth story. You do very little in the way of M&A.
But they look at revenues, they look at operating income, and as you said earlier, our revenues are up 11%, operating income up 16%. I would try to do that every quarter if I could.
Right, but they wonder if the trajectory slows, and they're still looking for growth. They still want to see more earnings. They still want to see more revenue. How do you get it?
No firm in the investment management business is more positioned, whether it is index or it's alpha products. And more importantly, we didn't talk about technology. Our technology services business was up 25% last quarter. 25%. And
this is the business that includes Aladdin.
Yes. And we redefined it because Aladdin is a lot more than what it used to be. With Aladdin for wealth, Aladdin a provider, working with custodial banks. And so we actually have great growth. I mean, we've never had a 25% growth rate in our technology business.
Is it accelerating?
It accelerated this quarter. We're not, we're we're not going to state that it will continue to grow at this rate, but it certainly accelerated from the mid-teens to 25%.
So technology has been one of your strategic priorities for a long time.
Correct.
What else is on that list right now?
We are working on retirement, on new ideas for retirement. We are in deep dialogue with some very large organizations on re-looking at how retirement and how corporations should work with their employees related to retirement. If we succeed in this, we will see huge opportunities for growth. We've invested large sums of money in our alternative space, and we're starting to begin to see many more flows. We're going at a rate now of, $16+ billion a year in alternatives. And that's one thing that we are trying to get most of the investors now to start looking at. It's not just about asset flows, it's about revenues too, because we could lose $16 billion or $13 billion in index equities and lose a few $100,000, and we could pick up $1 million of interest in some type of alternative product.
It's a higher fee business, higher margin business.
And so what we have worked with our investors over the last year is this, focus on revenues. And I think we proved in the second quarter that revenues were quite strong.
Alternatives, on a relative basis, is still a small piece of the BlackRock puzzle.
$130 billion and growing.
So you compare that, as people do, to the KKRs. KKR is about the same size.
Right.
But the Carlyles, for example, the Brookfields, the Blackstones, and BlackRock looks small in alternatives.
We're the 6th largest alternative manager and growing. So I think that's one area in a few years when you said, what are we going to look like? We're going to be higher than number 6 in alternatives.
Do you need acquisitions to gain scale in alternatives?
Well, we did Tannenbaum. We did a small little acquisition. The answer is, we're in the midst of growing our long-term capital fund right now, which we hope to have a close in the coming months, or the initial close. So the answer is probably not. We see very good opportunities right now. We had the best quarter in terms of flows and potential new flows going into the third quarter.
Probably not, but on a case-by-case basis, does it make sense to do more Tannenbaum Capital Partner type deals?
We're not presently really looking at anything in that way. If we had to do, as I said in the past, if we were looking at some mergers that I think will be transformational, be more in technology for us as we continue to build out our Aladdin services or our technology services.
Why do you need to do a transformational deal in technology?
It's just to continue to add on to what we already have. And as I said, when you could grow this business at double-digit growth and as high as 25%, we see more and more opportunities. And as I said earlier, the opportunities here has never been stronger for us.
What does a transformational deal in technology look like for a BlackRock?
It could be a small little acquisition, but it might be important technology for the future. One of the great little technology acquisitions we made that's changing our cash management was Cash Matrix. And so it doesn't have to be of large scale, but it changes our positioning. It changes how we are interacting with our clients. And so it could be small, it could be large, but if we see something that is really transforming us within a specific business, like Cash Matrix is in our cash business, and unlike the industry, we had growth in cash, we will continue to invest in those types of technologies.
Larry, what about AI and systematic investing? Not so long ago, this was a big priority. Where is it now?
It still is. We opened we opened up a tech center at Stanford University. We're going to announce opening another tech center at another city at another university where we're working on AI. We're working on model-based investing and algorithmic investing. And we're just as committed as ever.
Is it true that you're building out a cryptocurrency capability?
No. I mean, we're looking at it. As I said in the past, we are very excited about blockchain technology. That's what we're looking at, even in the Aladdin universe, what we're trying to do there. So we're looking at blockchain technologies, and we're looking at all the
crypto. But blockchain isn't crypto. Blockchain is just the underlying technology.
Well, that's the most important thing. Whether it is a cryptocurrency, we're studying them to see how they're performing. And it may be,
Don't your clients want crypto exposure?
No, I don't believe any client has sought out crypto exposure.
Really?
Yes.
But at some point they might. Do you need to be prepared?
I don't, at the moment, no.
It's interesting.
Yeah.
I mean, Goldman Sachs is building out a cryptocurrency trading desk. Morgan
Good.
Stanley is
well,
doing
I'm
the
not
same
in the
thing.
trading
JP
area.
Morgan's doing the same thing.
Yes, because there's elements of people who are looking to trade it. I have not heard from any one client they're looking to buy a cryptocurrency at this time. When it becomes more legitimatized, when it has the true open nature of it, that you identify who the players are on both sides, that's when we'll probably look at it as an alternative, to all currencies. But I have
right
not,
now you are where then? You are
What do you mean?
just studying it?
We're studying it. We're looking how they perform. We're looking at that type of data to understand it as we think about other products. But right now, I can tell you it worldwide. I have not heard from one client who said, I need to be in this.
Larry, one of the things people associate with BlackRock is a commitment to ESG, environmental, social, governance.
Right.
You take the trouble to write a letter to CEOs every year that touches on many of those issues. And
Right.
furthermore, you go on at greater length in your chairman's letter.
Yes.
The problem you run into, and I know you're well familiar with this, is that people can interpret or perhaps confuse what BlackRock has to say about those issues
Absolutely.
with politics.
Yes.
How do you avoid creating the impression that you're playing politics with your clients' money?
Well, that's by repeating what we are doing. We're an asset advisor, not an asset owner. We're advising our clients or asset owners as to what they should be doing. We're offering choice, but we are not playing politics, and we never meant to be playing politics. And I do believe that message is getting out, and I do believe the reaction to my corporate letter has been profound.
It has.
Profound. If you read most chairman's or CEO's letters, they talk about their corporate purpose now. And we'll find out over the next 5 years how they live in that purpose. But they're now providing much more transparency to the investors. They're talking about their long-term strategy and how they're trying to manifest that. So I would say what we're trying to do is opening up more transparency. We're seeing that. And in terms of how we vote, that's an independent committee that does their voting. It is on a case-by-case basis. What we are doing is we believe we need to have a higher fiduciary responsibility in executing that. This is why I suggested we are going to raise our team to about 75 people, more than double anybody else in terms of corporate stewardship. And I do believe, and we're finding this out every day, corporate stewardship is becoming more and more important. Corporations are being asked by society to do more and more. I'm not asking them, society's asking for them, and we're making sure that companies are listening to society, and that's what we are doing. But our job, number one, is investing in companies that perform well. And if companies focus on ESG issues over a long horizon, there is evidence that they actually do better than companies that have governance issues, that companies that have a big social issue. So actually what we are doing is raising the bar, providing more transparency, building a better understanding of how companies navigate their business. And I believe the outcome will be better performing.
So you're not pulling back from a commitment to stewardship one bit?
Not at all. Why would I? I think it's the right thing to do. And I do believe from our investors across the board, 90+% of our investors are very thankful that we are pushing this. There is always a few that are not terribly happy, but overall the response has been overwhelmingly positive. And I'm hearing from many people within our firm, our employees are actually very excited to be associated with a firm that is raising these questions. And so I would say, if you look at the ability of hiring people and hiring millennials, we have never been in a better position. Even this year, we had 250,000 applicants to come to BlackRock and for a few hundred jobs. And so I do believe we can make a difference. We can make a difference for our clients. We can make a difference for our employees. And hopefully we'll make a difference in all the societies in which we operate.